Hello, everyone. I'm Amy.
And I'm Tom. Great to be here.
We see these markets hitting new records, especially when the world feels, well, pretty uncertain sometimes. It really makes you wonder, doesn't it? What's actually driving things? And maybe more importantly, how long can it last?
Exactly. It's a key question.
So today we're going to do an in-depth exploration into the latest market moves and the economic signs shaping them.
Yeah, we want to pull out the really important insights from all the recent updates and data.
Right. Help you cut through the noise, understand where we stand now, and maybe, just maybe, spot what catalysts might be coming down the pike. We'll try to find those surprising connections that, help it all make a bit more sense.
Sounds good. Where should we start?
Okay, let's unpack this. The NASDAQ 100, it actually hit a brand new record high yesterday, closed at 22,447.29.
Wow, that's significant.
And it's not just the 100. The S&P 500 and the NASDAQ Composite are also like right near their all-time highs too.
It's been a strong run.
It really has. A pretty remarkable recovery, especially if you look at the NASDAQ Composite. It's up, something like 32% just from its low point back on April 8th? Stunning.
A huge climb back.
But, and this is the critical question, I think, for all of us trying to stay informed, given these highs, these record levels, what future catalysts are actually needed? What's going to push the market even higher as we look towards the second half of the year? Is there enough fuel left in the tank?
Well, what's fascinating here, Amy, and maybe a bit surprising, is that this momentum, this market strength, it appears to be really driven by a renewed enthusiasm for tech growth,
Yeah.
almost singularly focused on that.
So tech is just dominating the narrative.
It seems that way. It's actually outweighing concerns that would normally give investors pause, things like geopolitical volatility, which we still have, and even high valuations in some of these very tech names.
Interesting. So the excitement is overriding the caution signals.
Pretty much.
Mhm.
And alongside this stock surge, we also saw some other interesting macro moves. U.S. Treasury yields actually went down. Brent crude edged up a little bit, and the euro got stronger, really quite strong against the dollar, its best level since, September 2021.
So a bit of a mixed picture outside of stocks, but tech is clearly the leader in the equity space.
That's the story right now, yeah.
That focus on tech growth, it's crucial. But to really get it, we need to look beyond just the sentiment, right? Can you maybe pull back the curtain on some specific companies? Who's really driving this? Maybe some surprising names?
Absolutely. The corporate stories really paint a vivid picture of this tech narrative. Let's start with Nike, actually. Not pure tech, but interesting.
Oh, okay, Nike.
Yeah, their recent sales actually beat expectations quite handily. And it's not just the number. It signals a strong recovery. They seem to have managed their inventory well, clearing the way for new products. It's a pretty significant turnaround for them.
Okay. A comeback story. What about the core tech, the AI stuff?
Right. Turning squarely to AI. We've got Meta Platforms. Reports suggest they're in advanced talks to buy Play AI.
Play AI, what do they do?
They specialize in voice replication using AI. Now, this isn't just Meta adding a cool new feature. It looks like a strategic move.
How so?
It really underlines their broader strategy, grabbing top talent, accelerating their progress in this super competitive AI race. It shows where the big players think the future of engagement is heading.
Got it. Securing the talent and the tech.
Exactly. And speaking of AI's impact, you have Salesforce CEO Mark Benioff talking recently about AI's potential for labor automation. He actually said Salesforce has already automated a significant chunk of its own internal work.
Wow. So it's not just talk, it's happening.
It seems so. It
Yeah.
gives you a real glimpse into how AI is fundamentally changing how businesses operate, boosting efficiency maybe, but also raising those big questions about the future of work.
Yeah, those are big questions indeed. So lots driven by AI. Is the market betting heavily on that reshaping whole sectors? What else stands out on the corporate front? Any other areas catching attention?
Yeah. Another standout, and this one shows a kind of broadening acceptance beyond just the usual tech giants, is Coinbase Global.
Ah, crypto.
Right, their shares hit an all-time high. And this rally seems fueled by crypto becoming more accepted by, Wall Street institutions, even policymakers in D.C.
So moving more mainstream.
It looks that way. Pretty remarkable, really, for a sector that was often viewed very skeptically. It could open the door for more institutional money down the line.
Interesting. But it can't all be good news, can it? Any counterpoints?
Good point. To keep it balanced, it's definitely not booming uniformly across all of tech. We saw Micron Technology, for example, issue a kind of less than rosy outlook. That put a damper on its big 2025 rally.
Okay, so a reminder it's not monolithic.
Exactly. It shows that even with positive sentiment overall, specific companies or subsectors can still face their own unique challenges. It's not all smooth sailing.
And if we look at the S&P 500 sectors overall,
Communication services was the clear winner yesterday, up about 1.77%. Think Warner Bros., Discovery, Netflix, Meta again, that tech and media link is strong.
and the laggard.
That was real estate, down about 0.64%. Companies like Equinix, Avalon Bay took hits. That divergence tells you a lot about where investor confidence is right now.
And the mega caps, the really big names.
Mostly up. Alphabet, Amazon, Meta, Microsoft, Nvidia all gained. Interestingly, Apple and Tesla were slightly down, just slightly, but maybe notable given the overall tech push.
Okay, so a clear picture. Tech and AI excitement driving market highs. But how does this square with the broader economy? It feels like we're getting some really mixed signals there, don't you think? How should we read those?
That is precisely the challenge right now. It's creating quite the puzzle. Thursday's U.S. economic data was, well, a real mixed bag. Makes it hard to get a clear read on economic health.
Like what, for example?
Okay, take jobless claims. Initial claims, so new filings, came in better than expected, 236,000 versus a forecast of 245,000. That sounds good, right? Resilient labor market.
Fewer layoffs starting.
But then, continuing claims people already getting benefits, they rose to 1,974,000.
Yeah.
But was higher than forecast and actually the highest level since November 2021.
Huh. So fewer people starting claims, but more people staying on benefits longer.
Exactly. It's this critical, almost contradictory signal. It suggests maybe finding a new job is getting tougher, even if mass layoffs aren't spiking. A sign of underlying softness, perhaps.
Okay, that is confusing. Anything positive?
Yes, surprisingly positive on one front.
Yeah.
Durable goods orders. For May, they jumped 16.4% month over month.
16%.
Yeah, huge. Way above the 9.4% expected gain. That's the highest level since July 2014. It's a strong sign for business investment, future production. Looks good for economic activity.
Okay, that sounds much better.
But then, just to muddy the waters again, the final reading for Q1 GDP revised down to a
Okay.
0.5% contraction, worse than previously thought.
So we started the year weaker than we realized.
Right. It's like the economy is sending us three totally different messages all at once. Strong investment, weakening job security for some, and a sluggish start to the year.
That definitely sounds like conflicting information. How are these mixed signals, especially from the labor market, playing into what people expect from the Federal Reserve? With interest rates, that's always huge for markets.
It's creating significant churn in those expectations, definitely. We saw Treasury yields fall, partly reacting to that weaker continuing claims number and the shifting rate outlook.
So the market's thinking cuts might be coming sooner.
Well, what's fascinating is the clear divide within the Fed itself. You've got some governors, like Christopher Waller and Michelle Bowman, openly suggesting a rate cut could even happen as early as July.
July, that scene.
That's what they floated. But that's in stark contrast to Chair Powell and others, like Thomas Barkin. They seem much more cautious, preferring to wait, worried about tariffs maybe pushing inflation back up.
So internal disagreement at the Fed.
Seems like it. And the market right now. It seems to be listening more to the dovish voices.
How's that showing up in trading?
Fed funds futures traders are now pricing in about a 21% chance of a cut in July. That's up from just 12.5% last week.
A big jump.
Yeah, and a September cut. That's now seen as almost a certainty, 94% probability. Traders are basically pricing in about 65 basis points of cuts total by the end of the year.
Wow, so the market's betting heavily on the Fed easing soon, and quite a bit, maybe because of that labor market data.
That seems to be a big driver, yes. It's a significant repricing, showing the strong belief the Fed will need to act sooner and maybe more aggressively than we thought just a little while ago.
That is a really big shift in expectations so quickly, and it brings up another point, the dollar. Why is it hitting a 3.5-year low against the euro and sterling? What's the link there?
It's directly tied to those shifting rate expectations, and specifically the difference in expectations between the Fed and other central banks.
The differential.
Exactly. Traders are anticipating more aggressive Fed cuts compared to what they expect from, say, the European Central Bank or the Bank of England.
And lower expected rates make a currency less attractive.
Generally, yes. Less yield potential. That's why the euro's pushed up to its strongest since September 21, around $1.17, and sterling hit its highest since October 21, near $1.37. It's a classic currency reaction to anticipated interest rate moves.
Makes sense. And there's another layer here too, isn't there? The politics around the Fed chair nomination.
Yes. That adds another whole dimension of complexity. The current U.S. president has been openly critical of Powell's, let's say, more cautious stance on rate cuts.
Right.
And he's expected to nominate someone perceived as more dovish, more inclined to cut rates when Powell's term is up.
When might that happen?
Well, the Wall Street Journal reported the president might even announce a replacement pick as early as September or October.
Before Powell's term is even over.
Potentially, yes. And analysts think this move could undermine Powell's influence in his final months. It could create this sort of shadow Fed chair dynamic, where the market starts discounting Powell's signals because they expect to shift in direction soon.
So more uncertainty, but potentially pushing expectations even more towards easier policy down the road.
That's the thinking. It adds another layer of political influence onto the economic calculations.
Okay, let's maybe zoom out a bit then.
Yeah.
Look at the global stage, what's happening with commodities and in Europe. These things can definitely be catalysts too, maybe in surprising ways.
Indeed. On the commodities front, gold prices were pretty stable, actually down just a tiny bit, around $3,325 an ounce.
Stable despite everything.
Yeah, it seems like investors were mostly monitoring the Middle East situation after tensions eased a bit. Normally, easing tensions might push gold down more, but it held firm. And it's crucial to remember, gold is still up massively, like 26% year to date. Still a key safe haven indicator.
Okay, what about oil?
Oil prices nudged up modestly. Brent was up around 0.2%. The main driver there was a pretty big drop in U.S. crude inventories.
Inventories fell. Why?
Down about 5.8 million barrels. Seems to be due to refineries ramping up activity and also demand picking up, probably from the summer driving season finally kicking into gear.
Ah, summer demand.
Right. And a weaker dollar also helped a bit, making oil cheaper for buyers using other currencies.
But the gains were small?
They were limited, yeah. Mostly because the Iran-Israel conflict ended quickly, reducing that geopolitical risk premium. Plus, the U.S. president mentioned potentially seeking a nuclear commitment from Tehran in talks, and even hinted at possibly easing enforcement on their oil sales to help with reconstruction.
So less supply risk perceived by the market.
Exactly. Just for context, Brent is still below where it was on June 12th, the day Israel started those airstrikes on Iran. Shows how quickly that risk premium evaporated.
Got it. And shifting to Europe, any key catalysts emerging there, maybe around fiscal policy or economic trends?
Well, European stock markets were a bit mixed. The German DAX was up, French CAC 40 slightly down, UK FTSE 100 slightly up. Kind of a mixed bag.
Okay. Anything more significant happening?
What's particularly interesting and could be a future catalyst is the German bond yield curve. It continued to steepen.
Steepening curve. What does that usually signal?
It typically means investors want higher returns for holding longer-term debt. Often points to expectations of higher future inflation or more government borrowing down the road.
And which is it in Germany's case?
Mostly seems driven by expectations of increased government borrowing. German lawmakers just approved a pretty big multi-billion euro fiscal relief package designed to boost investment.
So stimulus spending.
Essentially, yes.
Yeah.
And markets anticipate this will mean Germany needs to issue more bonds to fund it all, which tends to push those longer-term yields higher.
And that ties into anything else?
It does. It aligns with that recent agreement by NATO leaders to boost defense spending up to 5.0% of GDP. Germany, which has a bit more fiscal room than some neighbors, already unveiled a draft 2025 budget with record investments. So that fits the narrative of increased government spending, which could definitely be an economic driver, but also means more borrowing.
Right. Okay, so we've covered a lot, a really complex picture, isn't it? We've got markets hitting records, largely thanks to tech enthusiasm. But then we have these very mixed signals from the U.S. economy, especially the labor market.
Definitely confusing signals there.
Which is feeding into rapidly shifting expectations about Fed rate cuts, and that's hitting the dollar.
Big swings in rate expectations.
And then globally, we have evolving dynamics in commodities, shifting geopolitical risks, and changes in European fiscal policy on the horizon.
A lot of moving parts.
So the core question we started with, it really still stands. Where are those next catalysts going to come from? What should we be looking for?
Okay, well, to give you a few things to watch very soon, actually today, keep a close eye on the Personal Consumption Expenditures Price Index, the PCE data for May.
The Fed's preferred inflation gauge.
Exactly. Investors will be dissecting that for clues on inflation trends. Also, we have speeches scheduled from Cleveland, Fed President Beth Hammack, Fed Governor Lisa Cook, and New York Fed President John Williams. Their comments will be crucial for understanding any subtle shifts in the Fed's thinking.
Okay, Fed speakers and PCE. What about Europe?
Look out for French CPI data and the broader Eurozone sentiment indicators. Those will give us a better read on economic health across the continent.
Got it. So lots to watch immediately.
Yeah. And maybe stepping back, this whole situation raises a really important question for all of us to think about. Given that the market's current momentum seems so heavily weighted on tech and AI, right?
Mm.
Even with mixed economic data and geopolitical stuff simmering.
Right. Tech seems almost detached sometimes.
Exactly.
Yeah.
So how might the nature of the catalysts we should look for in the second half of the year be different from what's traditionally moved markets? Are we truly in an era where, tech breakthroughs alone can keep overshadowing conventional economic indicators and driving these big gains? Or is there a point where the broader economic reality has to catch up?
That's a really provocative thought to end on. Will tech momentum be enough, or will fundamentals reassert themselves? Something to definitely mull over.
For sure.
Okay, well, that's all the time we have for today. Thank you for your attention.
Hope you found it useful.
You can subscribe to our podcast if you like it. And we'll be back soon with another exploration of the ideas shaping our world. See you next time.